Hello and thank you for joining me today. My name is Wesley Boudreau, one of the financial advisors here at the Retirement Group. Given the severe increases we've seen in inflation so far through 2022, the Retirement Group thought it was more than appropriate to give AT&T employees kind of a mid-year update and let you know how this could affect your pension calculations, especially for those of you that were on the fence of retiring in 2022 versus 2023 or maybe even into 2024, because it is going to have a big impact if you're thinking about taking the pension as a lump sum. Before I get started, I just want to remind everybody that the Retirement Group we are not affiliated with, nor are we employed by AT&T. However, we've been working with AT&T employees and retirees for close to 30 years now, especially helping them transition into retirement and understanding the benefits plans so they can avoid a lot of the mistakes we do see from time to time. And one of those mistakes could be retiring at the wrong time and what your options are on your pension, whether you take the annuity or the lump sum and the appropriate timing for that. And that's what we're going to get into a little bit today as well. Now, if you do want to sit down with one of us face-to-face, we do have offices throughout the country, so we can still accommodate that. But obviously, if you have questions, give us a call at 1-800-900-5867, and we can take care of you that way. We can have a webinar, or we can focus on exchanging information via emails. But ultimately speaking, if there's anything you take us up on, is our complementary cash flow analysis. I know a lot of you have done this already, and if it's been over a year because of the market changes and interest rate changes, it's probably important we update that and take a closer look at it again. If you have not done so, give us a call. This is a complimentary review. And what it will do is it will help you determine if you're on pace to meet the retirement goals you have. And we can also look at whether it means you need to work longer or if you could retire earlier, especially given the information we'll talk about here in just a moment. So let me kind of back up. As far as AT&T, what we're going to talk about is the interest rates and how they're affecting the pension lump sum calculation. With AT&T, you may have a classic defined benefit pension plan, which runs a calculation to determine what your single life annuity is going to be, and then everything else is developed from there. Or you may have a cash balance plan, which is a little bit different. But what we're going to talk about today is the classic defined benefit plan. So what they do is they actually they run a calculation to determine based upon your final average pay and everything to determine what your single life annuity is going to be for the rest of your life. From there, you can deviate. You can say, I want to have a joint survivor annuity or a period certain so I make sure my beneficiaries are paid out longer. Or you can say, I'd like to take that money and manage it myself because I think I can do better than what that annuity provides. Or maybe you got longevity issues. You don't think you'll live that long, so you want to make sure you get your money back out of the plan. That's where you come into the lump sum calculation. What they do is they look at your life expectancy. So you look at average life expectancies, your age, to determine how many more years or months they have to pay you that potential income. Then they look at the current interest rates to do a net present value calculation to determine how much they have to give you. So ultimately speaking, when interest rates are lower, they have to give you more because it's that much tougher for you to go out there and try and recreate that annuity stream with lower interest rates. So think about it like a mortgage. When interest rates are low, you can get a bigger house. Now, we've experienced some pretty low interest rates here the last few years because of the pandemic, which is one benefit to you if there's any such benefit from the pandemic. And we've seen record numbers in lump sum calculations. And we've seen a lot of people leave in the last year or so because of this. But now on the flip side, interest rates are going up, and they're going up dramatically and quickly because of inflationary pressure. So it could have a major change in your lump sum calculation for 2023. So let's take a look at this chart here. And I know it's pretty busy, but you can take some time looking at it later. But I want you to focus primarily, let's look at that top line. The top line, what happens is the interest rates that AT&T uses are November for each year to determine the following year. So the interest rates used for November 21 will give you what you're going to use all of 2022. And they use segment rates. And the first segment's at 1.02%, then 2.72%, then 3.08%. Now those segments, what they do is they correlate to years of retirement. The first segment's going to be your first 5 years of retirement. Second segment's going to be years 6 through 20. And the third segment, years 21 and beyond. So for most of us, depending upon what time we retire and how old we are, that second segment has the highest weighting because it's going to cover about 15 years of our retirement. So again, they use those interest rates, the current annuity payment you're getting, to calculate how much of a lump sum they have to give you. Now, the benefit of AT&T is since they do it just once per year, you have a little bit of an idea of what things are looking like, and that's where we are right now. We're only 4 months into the calculations for this year because the March rates came out a couple weeks ago. We'll see the April rates coming out here in another week or two probably. But so far, if we focus back on that middle row or the middle column, the second segment, if you go down to the bottom, in just 4 months, those interest rates have gone from 2.72% all the way up to 3.71%. that is a full 99 basis point move. That's about a 1% move. So I want you to remember this for a simple rule of math. A 1% change equals roughly about an 8 to a 12% change in your pension lump sum calculation, depending upon your age. So simply put, a 1% equals about 10% usually. So in this case, that 99 basis points means if you were retiring this year versus next year and you ran your pension lump sum calculation, you're likely going down by at least 10% next year. And this is only through March, so we have to wait all the way until November, which we won't get those true numbers until close to Christmas time because the IRS releases them about 3 weeks later to know what the severity is going to be. So even if interest rates leveled off and stay where they are right now, you're probably seeing at least a 1% drop, at least a 10% drop in your lump sum. Now, it's very likely we could see this go up even higher, and you could see a 15% drop. It's theoretically, you could see a 20% drop. So let's say you run your numbers and you've got a $500,000 pension right now, and you were thinking about retiring this year or next year. If you're going to take the annuity, it doesn't matter on this. But if you're thinking about taking the lump sum and you wait until next year, that $500,000 pension could drop down to $450 or maybe even lower, $425 when it's said and done. If it was $1 million pension, it could drop by $100,000 or more. So I don't know how much most of you make during a year, but in some cases you could be working for free if you decide to work until next year. Or you might have a break-even analysis and say you have to work all the way through, let's say August, just to offset the pension that you would have lost, not to mention the taxes. So if you are on the verge of retirement, I'd say within the next 3 years, maybe in the next 5 years, and you have questions about this, give us a call so we can run through these numbers with you, because you're seeing a potential severe drop in your pension if you wait till next year. And we've got plenty of time to kind of run those numbers and have an idea of it ahead of time versus everybody scrambling in the fall to try and make a quick decision. We don't want to see that. Now, this next chart, let's go in here just to give you an idea of where those rates are historically. This is going back 10 years, and what I did is I just took a look at the second segment because, again, that's the one that's got the most weighting for most of you. But if we go in here, we'll see that we're approaching that 3.7 range, so we're approaching getting back up to above 4%. And if you notice, it wasn't that long ago we were above 4% back in 2014, back in 2019 or so, and we kind of hovered around there in the high 3s, low 4s. So this is not unheard of. We're just essentially kind of correcting back out of the pandemic drop that we saw in interest rates. So that's why I say right now we're seeing about a 1% change probably, but it could be higher. We could see 1.5, which would equal like 15% change or so on your 401k. So again, ultimately, this is just kind of a quick update to let everybody know what's happening, and give us a call to run some numbers if you have questions on there. But right now, like I said, that cash flow analysis, about 3/4 of Americans over 50 don't actually even have a written plan put together. If you haven't done so already, if you want to spend about 10 minutes with us gathering some data as far as the pension calculations, your 401k, desired retirement date, age, things like that, we can run that cash flow analysis for you, show you where you stand, and also go through this if you are leaning towards a lump sum, if you have that choice, what those options are. And we can run that cash flow analysis to show you the annuity versus the lump sum side by side, not just what it looks like now, but in 10, 20, 30 years down the road as well, and go through all that information with you. So with that, again, I just want to spend a quick minute. I just wanted to spend a couple minutes giving you a quick update on that. But ultimately, everybody's case is individual. So call us at 800-900-5867. You can reach at info@theretirementgroup.com. Or you can also hold up your phone to one of these QR codes if you'd like to schedule an appointment with myself or one of the other advisors in the offices. Or if you'd like to follow us on LinkedIn and make sure you get updated on the AT&T specific page. So that way we give you updates on these interest rates, updates on other webinars that we have coming up, and typically we come out with those every week or two as well. So again, just want to remind everybody that we have worked with AT&T extensively for about 30 years. However, we are not employed by nor affiliated with. But ultimately, when it's said and done, if you have any questions or want to avoid some of the mistakes we see, just give us a call at 1-800-900-5867. We'll be more than happy to help you out. So I want to thank everybody, and I hope you have a great day.